We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke, Britton Financial Partners. Welcome to episode 3 of the Finances podcast. I'm your host, Jay Burke, Managing Director at Burke, Britton Financial Partners. I'm joined today by my co-host, colleague, friend, and certified financial planner, Ben Kemp. We start by discussing the reluctance most people have in discussing death and estate planning and the risks this reluctance creates for families and for finances. We look at the fear of looming interest rate rises and what action people should be taking both now and in the future to benefit from them. We unpack some client questions around how baby boomers can help their kids into an inflated property market. And finally, we emphasise the importance of spending up and doing things you want to do while you have the window of time, money and health to enjoy. We hope you enjoy this discussion. Estate planning as a key part of what we do. I was thinking about this morning as I was coming into work. You know, we live in a time now where we're constantly reminded about death and dying. I mean, the media gives us coronavirus and wars, and it is something that a lot of people put their head in the sand about, and it becomes too hard to think about, something that you don't want to consider. We spend all this time as financial advisors building people's wealth, managing their affairs, and then people just sort of turn away, look away, don't want to think about what happens if I die.
It's funny when you meet a new client, you run through all the, what's your income, your expenses, your goals, everything. You usually get down to estate planning later on in the conversation, and the mood changes immediately. They sort of withdraw. Oh, no, I haven't. Oh, you're meaning to. Oh, we had that on the list. That's usually what they say. I don't get it. It's not that sexy to talk about. It's not fun.
It's not that sexy, but we've said it in previous episodes that it's not a problem until it's a problem. I know it's fairly fashionable to be reading the Stoics, but the whole philosophy of the Stoic philosophers was that you needed to be comfortable with death, and that once you were comfortable with death, you had a sense of ease, that there was nothing to worry about. And that's kind of what we need to be thinking from an estate planning point of view, is you have to get it in order. And there's a number of things that we as financial advisors are very big on encouraging people to do. Probably the first question, like you said, you get down to that part in the conversation with clients and ask them, so tell us about your will, and you get some blank looks, and you realise that I think percentage-wise, the majority of people don't even have a will.
I was going to say the line, you say, look, they go, we haven't done it, we know we should have. And I nearly always say, well, you're in the majority, not the minority. Most people don't have it, and the ones that do, it's almost worse than the ones that do have one, because it's that old, it's their ex-husband, their executor died 10 years ago, they're outdated. So and again, I say to them, we're not going to be in here every year looking at your will, but we need to be conscious of what you've got, making sure it's still appropriate, make some tweaks over time. It's just another piece of the evolving strategy of your overall financials.
So on our website, we've got a section on estate planning that people can go and check out, but I suppose the key things for us, I think we can deep dive into estate planning as a topic, but first of all, people need to have wills and powers of attorney. Yes, there are instances where people probably aren't in a position where they desperately need them, but by and large, people should have a will. If you have an existing will, you should pull it out and review it. The other thing that gets bundled into sort of the estate planning conversation, and a lot of people confuse your executor with your power of attorney. So maybe if you just touch on the differences.
Or beneficiary, yeah.
Yeah, and beneficiary as well. Those three get confused and sort of considered as one. People go, yep, I've got my estate in order, or I've got my executor in order. What they mean is they've got their beneficiary on their super completed, or they have a power of attorney, or they confuse their power of attorney with the executor. So
it's maybe in order of what they usually would play out, being that the power of attorney is when the person's alive. That's how I always explain it to the clients, is that the power of attorney is acting for someone who's incapacitated or unable to act for themselves while they're alive. So it's the sort of the living role.
An executor is the person that's in control of your assets and your estate in the event of your death. The power of attorney is the person that is in charge of your finances in the event, or your medical circumstances in the event that you're either incapacitated or you're unwilling or don't want to handle those affairs yourself. And your beneficiary nomination is actually separate all again, and it is the person that is the recipient of your superannuation in the event that you were to pass away.
Which gets blended again with then the executor executing the will to then essentially those, who benefits from those proceeds.
Yep.
So again, it's confusing, and then people don't like things that they don't understand simply, so they usually then just steer away from it. And some people get some legal advice that's probably been questionable over time, where they will do a will, but they don't encourage them or explain the need to have a power of attorney as well.
Yeah, and even the difficulty in explaining that in a short form in a podcast is the exact reason why people need to get support around these things. And when we start to expand estate planning and look at how it ties into financial planning, it's so interrelated with people's assets. It's so interrelated. I know we were going to talk about how families sort of manage their assets during the course of their life. We have circumstances where clients or parents will gift their children unequally during the course of their life, and want to make sure that when they do finally go to God, that things are nice and even and equalised. If you don't have a will, you've probably got zero hope of what you want to happen actually happening in the event of your death.
Even with the one, it still doesn't end up accurate if it's not accurate in its sense of what's actually written up. Like
maybe it improves the odds.
it, but you need to make sure it's relevant. That's the thing. And if you, over time, your situation will change. You help one child, you help the other child. You want to make sure it's reflected through that will as accurately as possible. Hence, you don't just do it and then put it in the bottom drawer forever. It might sit there for 5 years. It might sit there for 2 years. For some people, it might be accurate for 15, 20 years, but you still got to check it. You've still got to make sure it is still accurate. Make sure it still aligns to what your wishes were at the time. So people's needs and desires change drastically in that space.
Yeah, and the other thing, which again is referenced on our website, is how estate planning ties into things like businesses and family trusts, because particularly with people that are actually accumulating a good amount of wealth, we have different scenarios to help them manage their sort of tax position and the protection of their assets while they're alive. And that throws another complicating factor into how people manage their estate. So I think for anyone listening, really, if you haven't got a will, you should at least be going and talking to someone about the validity of it for you and your circumstances. And if you've got any reasonable quantum of assets, then you definitely should be getting some advice about how to manage them now, and also how to manage them in the event that you're no longer with us.
I'm not sure if we want to go deep down the rabbit hole of testamentary trusts and these sort of things, but just to flag what is out there is that there's provisions available that help from a tax perspective, but also asset protection, family wealth protection. Often we have clients have 2-3 kids. Chances are at least one of them is going to have a marriage or a relationship breakdown at some point in the future. How does that impact? And something happens to the parents, the funds pass through to the kids. That child has a marriage breakdown, and half of that inheritance walks out the door. What can you do to protect that and make sure that stays, in that family through to the grandkids and beyond to help them?
That's a good example, and there's probably at least 3 or 4 more examples like that you consider, where people want to make sure they might have, disability of a child is a good example. Someone that maybe is not going to have the capacity to manage an inheritance or a lump sum, and they need support. So estate planning and things like testamentary trust provision can actually help support, children and disabled children in the event that their parents were to pass. The other reason or instance might be you might have a child who's a delinquent and really has got no capability or potential to be able to manage money, or they may have They may have drug issues.
I was going to say, I've got one and they're three kids. One of them has a drug issue ongoing through their life and mental health issues as well. And they want, he's still their son, and they still want to, pass on his share of wealth, but they're worried what it would be a bigger negative on him than a positive. So setting up provisions to protect them from that.
Yeah. So how do you
some
put
intermediary sort of body in there to
some
make
control measures?
Yeah. So it's complex. It's got layers.
It's complex. It's got layers, but it's so important, and it is something that I think everyone needs to be comfortable with. Like it's a difficult conversation to have in a lot of instances, but it's an important one. It's one that we'd much prefer people get their head out of the sand, look at the entirety of their situation, and get some advice. And whenever we're talking about estate planning, inevitably it leads us down the path of considering many other aspects of people's situation. That's why, even if this is the entry point for people seeking advice, inevitably it'll unearth things that you haven't thought about. You don't know what you don't know, and I think it's a really good process to go down to review. We talk about sort of financial health checks. This is part of it.
Definitely. Again, like I said at the start, it's not the most exciting part. It's not the fun stuff, and most of the time it doesn't even impact the people you're sitting there talking to. But it gives them good comfort, I find, once it's all written up and done, that they don't have to think about that. It's not that scary. They know if something did happen to them that it's all sweet, it's all good. Everyone knows where things fit. They know where to go, who to talk to about what their assets are. It ends up being actually a not that bad, not that scary experience once they go through it. Yeah,
it's always unusual talking about a topic that you hope never happens, yet we all know that is going to happen. It's the most bizarre thing about death is that we pretend that it's never going to happen, yet it's the thing that's guaranteed of happening to us all. So get on board, get it sorted out, and sleep well at night. All right, we're going to move on. Ben, you had a couple of sort of broad topics or hot topics that you wanted to touch on, and it flows on from the conversation we had last week with Adam Dawes at Shaw and Partners around the interest rates. Is that where you want to start?
Yeah, I think it's just one of those things, and it probably gets thrown around loosely in conversation over the at the kitchen table at home or at work in all sorts of environments. People go, "Oh, interest rates will go up," because majority of people have some debt, some loans of some quantum, and they know interest rates will go up. And the anyone who's probably 45, 50 plus wants to tell you about the time when the rates were at 20%.
Yep.
That's usually the first thing they go to, and they tell you that when we were only earning $50 a week and we had to pay our mortgage, which was $20. House prices were blah blah, and how does that overlay with where we're at now? And people, you got complete different ends of the scale and going, house prices will crash by 20% once these rates go up. People won't be able to afford to pay them. What does that mean? No, we'll wait till next year. But and then you have other people thinking house prices will just keep going up no matter what. Interest rates won't slow them down. Got to get in. FOMO. So it's found it interesting as it sort of feels we're getting closer to that point where rates will rise, how people react to that. And they sometimes just use it as an excuse to make a change. Like they just use it as, rates will go up, so we want to get in early and we lock in the interest rate for a couple of years. It's pretty short-term thinking, really.
Well, I think you'd agree with me when we say that most of our thinking is long-term. Like we've got to consider today, but with an eye on the future, not disregard one for the other. Yep. And it's interesting when you start to talk about interest rates and the sort of the spectrum of views on what interest rate rises are going to do. It's almost like politics. You've got the two ends, the two sort of polar extremes, which are the noisiest extremes about, property prices are going to crash or interest rates are going to rise much quicker than we thought they were going to. The reality, if you look back, is it tends to be somewhere in the middle.
Like most things.
Yeah, like most things. It's you hear the worst at each end of the spectrum, and in the middle is the sort of common majority. And if you look back, history suggests that that's generally where things sit, but that doesn't sell when it comes to headlines and newspapers and media, and also getting people, I suppose, excited or interested about doing something. So whether it be home loan marketing or in real estate, the urging people to buy or sell at the right time. And we sound like broken records in all of this, but one of the best things that we do, and this is pumping up our own tires, and all financial advisors are doing a great job, is that we're always considering events like this. We're not just unexpectedly hit by an interest rate rise that we didn't know was coming. Like, we're constantly thinking about how do we manage people's portfolios and their cash flow and their asset position and their employment circumstances and their kids and their estate planning based upon all the factors that are happening at the one time. So that's why we tend to be fairly relaxed about these things. We don't get too stressed about them, but we understand that the people out there that have not got an advisor and don't have great sort of financial counsel tend to panic about these things. They read the headline and think interest rates are going up. They excessively panic, or they think that there is going to be more opportunity maybe than there really is.
Yeah, and sometimes, like I said, it's just an excuse to not, like, say that people are looking in the market, but they probably feel they're not quite ready yet. They go, oh, wait 6 months, rates will go up, prices will come down. I'll be good, good to go. And but then they start to doubt themselves. Will that happen? Will it not? I sort of have said to, as much as people probably don't trust government and things in certain times, they understand what would happen if they ramped rates quickly, and they don't want property prices crashing. They don't want people in mortgage stress. So it's going to be gradual.
A bubble that bursts is beneficial to not many.
No, and the last thing that people in government want is to have to be financially supporting people and in any way.
Yeah.
So it will be gradual. I think that there's the other side of it is, and this maybe is a little bit of a personal take on it, but is people generally, they get paid, they pay their mortgage, and what's left over, they then choose how they're going to allocate that. And most of the time, that's holidays, going out for dinner, new clothes, whatever it is.
Food fighters tickets.
Yeah, if you could get in the queue early enough. So the risk that we run as an economy, and for the government's sake, is that they know people will do that. They're not going to go out and sell their house in a month because their mortgage repayment went up by $100. They just won't go out for dinner on a Friday night anymore, which slows down all of these sectors that have been crushed for the last 2 years already. So they're conscious this is going to be, that's why it's going to be slow, because they'll let wage growth catch up, and they'll let people sort of stabilise, make some good decisions themselves, so they can keep stimulating the economy, keep paying their mortgage, and almost just go through this period of just no growth or neutral growth in the property space, most likely. Again, that's probably a bit of a personal take on it, but it will be gradual.
Yeah. It's whenever we start to talk about the broader economy, I've said this to clients, maybe it's a little bit too much of a catch cry, but the economy that they really need to be worrying about is their household economy. Like, that's the thing that you need to pay the most attention to.
Yeah.
So the deficit or the surplus in your own house and how you manage it is probably the most important thing. You don't have a lot of control over what the government's going to do with rates, and it's unlikely, as you said, that they're going to be ratcheted up 2% in the course of a month. So get a handle on your household, which then allows you to make much, much better decisions without panicking, whether it be around a property purchase, whether it be around refinancing your existing loan, whether it be around investing or what you do with that surplus cash flow. And I think we've mentioned this before as well, that whenever we're thinking about sort of modelling, one of the things that we do well is actually forecast what's actually coming. And we do, and I encourage everyone to. Like, you should be factoring in, like, if you've gone and purchased a property today at the very, very pointy end of your cash flow capability, you probably should be a little bit nervous.
Yeah, I saw an ad a while ago, which it's probably scared me as a bit of a pessimist and conservative. But it said, it was a broking firm. They said, we run our servicing based on today's interest rates, not a nominal one of 5%. So they're bumping up people's serviceability based upon rates being at 2%, but lending them more money, saying, well, yeah, you can afford it today, but what about 12 months, 2 years, 3 years? They're not going to pay their mortgage down in 2 years, most likely. So it's scary when you see that sort of stuff out there. I think with any young client, I try and almost spook them a little bit and say, well, send me a property that you're thinking of looking at. We'll run some loose numbers around what the repayments would look like, and then I just go 5%, 7%, 9%, and just run the interest rates up and go, how would that work for you? And just see what they, realistically, we probably hover in that 5 to 7 range at a point. So what does that look like for them? Because they need to be realistic at a point. That's where it's going to be at.
Yeah, and the danger is that people just say, I'll work it out, without actually having a plan of how would you work it out.
Working out means no more fun stuff.
Yeah, no more fun
bound
stuff.
to your house.
Yeah, or we haven't really factored in the fact that my wife's pregnant and she's going to be out of the workforce for a couple of years. They're all really important considerations, but I think, like I said, the on either ends of the spectrum, the very pessimistic or the very optimistic end of the spectrum, the reality lies somewhere in the middle, and the more well-placed you are with understanding your own circumstances, your own cash flow, your own ability to be able to afford things, I suppose, having a plan in place to be able to know what your objectives are with your cash flow, then I think the better place you are when interest rates do finally start to rise. And I don't think there's any question. I doubt you're going to disagree that interest rates are definitely going up. That's
they
the direction.
Can only go one way, essentially. So we said that a few years ago and said, only up from here, and then a fair bit unfolded after that. So they went down again. But again, we always probably be on that conservative side of things and say, well, let's just factor in them being up already. Like, what does that look like? And be one step ahead. It's better to be a bit conservative with your cash flow and your figures than to be the other way around and sort of run on hope. So I think the interest rate thing, it probably overlays with the other topic that I find coming up more and more, and it's probably been off the back of housing prices just continuing to, property prices running up at record rates, is people wanting to help their kids to get their foot in the door. And then they start to speculate about what interest rates will do, or they worry about their kids being able to fund it at higher rates and all those things. So again, I think the number one is that people have to look after themselves first, and then where their kids fit in around that, and being able to. Unfortunately, they need to help in a lot of circumstances.
That's kind of the oxygen mask in the plane mentality, isn't it? There's no point trying to help them out to the detriment of yourself, then everyone's dead. You look after yourself first.
A little bit, and that sounds selfish, but it's sort of, I've seen, I think you would have seen this more than I have, but I've seen clients where they've just basically, they've given the shirt off their own back to their kids and then had to just live a pretty mundane retirement life, where their kids are maybe earning more money than they ever had, but they still just felt this inclination to give to them.
Well, I've had a couple of examples that have, to the analogy of the oxygen mask in the plane and having to look after yourself first. If you don't, you run the risk that not only it's detrimental to you, but if that person fails. So the example that I've got is where clients lent their son some money, shouldn't have. That son isn't great with money, has made really bad decisions, has lost that asset, and then left that debt secured against his parents' home that they are struggling to fund. They've both failed. And so it is, again, another instance where you really need to be considered about your options and what you do. What other examples have you seen of how parents help their kids out?
Well, the good thing is there are multiple ways to do it. So obviously the most obvious one is just a cash, gift that helps them out with a deposit to start with. I think the one I've seen more and more of, and where it works pretty effectively, is providing security. So they're not actually giving up any money, but they're providing security over maybe their shortfall in deposit. So the kids have got 10%. Bank ideally wants some bit more security, up to 20%. So they use their home or an asset to say, well, we'll guarantor that 10% remainder. Once that 10% is no longer required, it can be removed. So that there's no real out-of-pocket expense for the parent helping the child. It just gives the bank a bit more comfort, which helps get a better rate, better terms for the child who's lending, and that's been effective. But again, you've got to be careful because you've got to know that they're good for it, the kids, and you've got to make sure they're not overextending themselves too.
Yeah, well, the nature of a guarantee is exactly that you've guaranteed that if that person can't fulfill their obligations and repay that loan, they look down the line and say, okay, well,
you're next.
You're next. The parents have put their property up. We're coming after you to get that deposit, that 10% of their property purchase back. I did that exact thing when we bought our first home. We had parents, my father-in-law, thanks Mel, that helped us out with using his property as a third-party guarantor. Now, it's been a little bit more difficult to do that of recent time, as I understand it.
Yeah,
so
there's limited options. I think, there's only a few banks that sort of still do it, and they've changed the way they do it to make it a bit more flexible now in terms of the guarantor. And the last few I've seen of this is only on that portion. It's not on. It used to be over the whole property.
Yep.
Now it's saying they carve it out into two separate facilities and say, all right, well, there's your 80% portion to the people who purchased the property. It's clean. It's not linked. Worst case, you've got this other 10 or 20% portion that's got the guarantor link to it. So there's not as much skin in the game to it. So it's quicker to get released later on. Again, it's not for everyone. Some people hate the idea of it, and I can understand that. And I've helped people set it up. I've helped people use other options that are more favourable as well. But sometimes cash isn't just readily available for a parental loan to their kids either. So again, they're the most common ones. Purchasing in joint name with parents and things, that's probably one of the ones I'd hate to see, because it's just messy. I don't like, again, there's a bit of personal in this, but we've seen when it just goes to shit, it's hard to fix. And you got you might have 4 personalities, 4 opinions now, because you got, say, a mum and a dad and then their son and their daughter-in-law. Like, you got 4 opinions on what happens next with the asset. It usually starts out great. It's always good at the start.
Seems like a good idea at the time.
Everyone benefits. Yeah, it'll be great. It'll keep cheaper. It's good investment. Yeah. Oh, trust the tenant. All these things. And it's a slippery slope. And it can be an expensive one.
Yeah. And then you have things like one party wanting to sell, the other one wanting to stay, and then they agree and they forget about stamp duty and transfer of ownership. It becomes a nightmare. So, again, it's another one that people should be getting advice around. How if you want to help your kids out in funding their property. I've had 2 in the last week where one was a cash gift, so they had the potential to do it. And actually going back to our estate planning conversation, the next part of our conversation after gifting, the conversation was, should this be a gift or a loan? So should this money be a gift or a loan? And I mean, the option exists for it to be either. If it's a loan, and sometimes that's the most appropriate, I would suggest that it should, wherever possible, be as best as possible, be at arm's length, which means that there's an agreement. There's just an agreed position. I always work on the assumption that things will go to shit. And if they do, you want to have a written agreement that says, hey, I lent you this, and this is what you agreed. You agreed to pay it back. If it is a gift, and to the estate planning question around equalisation, if it's a gift, do you want that gift to be equalised in the event of your death? So if you've given one of your children $200,000 towards a property and not the other, you're happy for that to be the case and just be written out of the estate, or do you want that child to actually receive $200,000 less? If that's the case, then you would need to make sure that you have the appropriate notations in your estate to reflect that.
Yeah. I think we're seeing more and more of it. It's always been a factor of parents helping their kids, but it's just becoming more scalable and just common because people want to get in the market.
Baby boomers have just made a bomb, haven't they?
Up.
Yeah.
Ruined it for the young ones.
Yeah.
You're not quite a boomer, eh?
Not quite, mate. 44. I'm Gen X. Gen X. What are you?
I don't know.
Millennial?
Feeling old.
Millennial?
Sub 30. That's all that matters.
All right. What else have you got, mate? What's next on the list?
Again, the last one, and we may be deep. Again, this might be more of a long form conversation in the future, but maybe we'll just touch on it. Which we could talk about. We could probably talk about anything for hours. I think, and the
question is going to be whether people listen for hours.
True. And yeah, maybe this is just reflecting on in the last few weeks. We've had a few clients that have passed away, which happens. Obviously, we talked about death a lot, but you just see people that don't do stuff early enough. And I think whenever we're talking to our clients, I'm saying we'll tell you we'll pressure you to spend as much as we pressure you to save. Like, do stuff when you can, when you want to do it, and you've got the financial and physical ability to do it and desire. Because too many clients just get to a point where they go, I can't be asked getting on a plane. 15 hours to Europe, good luck. 20, probably 24 hours, no chance. Couldn't think of anything worse. Happy to go down the RSL for lunch. Like, they just don't. They just get to a point, and then they've probably worked for 45, 50 years, accumulated wealth, and they actually go hard for 5 to 10, 15 years, and then they just pull back on it, and you just use it. Like, I think sounds very simple. It's probably maybe it's from Peter banging this into me a bit as well with his clients, but you've just got a window of time, and you don't know when that is. Yeah. So that's
do it. One of my favourite conversations with clients is the window of time, and that's time, money, and health. And listen, you can have all the money in the world, but if you don't have your health, then it's good for shit. So there's a window of time when you do have all those three, the sort of the trifecta. If you've got time because you've retired, let's say, you've got money because you've accumulated it, and you've got your health, what are you waiting for? Do something. And again, if it's within your means, get it done. And I think as humans, I don't think we think, it's hard to wrap your head around time, and you kind of apply how you are today to what your view of what retirement will be. And I don't even like, I've gone away from using that word retirement because I don't know even really what it means now. But to think that you're going to be in the physical shape that you are today, like, and you sort of defer things and go, well, when I'm retired, one day when I'm retired and I've got more money than I need, then I'll start to spend some money on the things that I want to do. No, you just don't know what's going to happen. You have no idea what's actually going to happen in the future. What we know for sure is that you're probably going to wane in your health. Things are going to go wrong, and you should take advantage if you've got the time and the money and the health whenever you've got it. It doesn't matter whether you're in your 20s or in your 70s. Within reason and within the scope of what you can afford to do, you should be doing stuff today. And
again, without beating our own drum here a bit, is we're pretty good at working that out for people. What they like, some people have. Everyone might want to have 3 months a year off and travel a lap around the world, but they can't simply afford it. So it's just about working out what you've got, what's a way to set money aside to meet those goals and actually do it without compromising your short, medium, long term. So most of the time, you can do all those things if you just have a system. It's so much it just comes down to setting a little bit aside, having those goals, working through them, planning it out, actually going, right, well, 2025, I'm going to take 6 months off. I'm going to, get a caravan, drive around Australia, whatever it may be. Just map it out, and then you'll know you can do it, and then you don't have to be worried about doing it. People don't do it from fear of not being sure or able. A bit like when they get to 60, 65, and they go, oh, I don't know if I can stop working. They probably could have stopped years ago, but they just didn't know didn't know. They just didn't have the ability to work that out.
Yeah, and this is definitely where we could go on a very big, deep dive. But people get stuck in the grind of doing what they do every day, and they don't stop and take the time to map things out and actually map out a plan and do the numbers on, can I afford this or not, rather than just having, keeping it in your head, the anxiety about, I don't think I can afford that. Well, work it out. Work out whether you can afford to do it. Work out what you want to do. When can you do it? What are the steps you actually need to take to tick off the things that you would really like to do. And we've said it so many times, people are going to be bored about it, but financial planning is not financial planning, it's lifestyle planning. We've got a limited time here on the earth. We should be doing the things that we want to do. The financial side of things is just a means to deliver the lifestyle that you want to live. And so if you're not fulfilling those lifestyle objectives that you want, whether it's travel, whether it is, buying a property, whether it's starting a family, whether it's starting a business, then you need to pause. You need to just sort of step back from the daily grind and the things that are consuming your time day to day. Take the time, go and speak to someone, and get some support. And I think that's where, the rubber hits the road in terms of us being able to help people, is to be that counsel and as a third party, reflect on people's situation, because we're not, well, at least initially, we're not emotionally involved in people's circumstances. So we can see very clearly where the shortfalls are in people's situation, or where they've got sort of a mental block around the things that they could potentially be doing, but they're not. Like, how many times you look at someone's situation and you can see right there the things that they should be doing, and it's right in front of them as well, but they just can't see it because they're busy. They're busy going to work to pay their mortgage and look after their kids, and they're just consumed with life.
And just the day-to-day, which is it. Even ourselves, we reflect on I'm sure you do the same thing. You reflect on your own financials from time to time and go, geez, like, we got to be self-aware of our own things and do it. And you see people in any profession where, they're really good at servicing other people and doing something, but then in their own backyard, they don't. You got to look back at yourself as well sometimes.
It's the plumber with the leaky tap, isn't it?
Yeah. That's just life. Life's busy. And everyone likes to say, when you say, how are you busy? It's just the cliche.
Mm. And some aspects of your life you need to outsource to some degree.
Yeah. I'm not going to go, there's things I can do and things I refuse to do. Like, could paint my house. I might do a little bit of it. I'm going to get someone to come in and do the rest of it, because it's not the most effective use of my time. Or I don't like doing it. I'd rather go and do something else, like just little things. And your financials, it's such a backwards one that you might have to spend a small portion of what it's actually worth, like of your total net asset position, to make it many, many times better. Like, I've had people, they might have $1.5 million worth of debt, and they're worried about paying $3,000 or $4,000 to get some advice around making that debt work for them, and maybe saving them $15,000 a year. They go, I'm not going to pay that. You go, you've got $1.5 million worth of debt. Your interest cost each month is who knows how much, and could be way worse than it should be. Like, sometimes people are irrational in terms of money in, money out, cost benefit. Yeah,
but we also get quite people get really focused on one aspect of their situation. It's not until you sort of take back and sort of look at the helicopter view of people's circumstances, you can see how each of the elements of their situation are interrelated. So, what else we got, Ben? You got anything else we want to talk about today?
Probably bored people enough by now. We'll roll them over. There's always something for next week.
All right, mate. Well, thanks for the chat, and we'll speak next week.
Thanks, Jeff.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.